So you're one of the millions of Canadians working for yourself. The freedom is incredible, right? But the taxes can feel like a total nightmare. Well, in the next few minutes, we are going to break it all down. We're going to make Canadian self-employment taxes simple, giving you a clear guide to handle your finances with confidence.
Look, being your own boss is amazing, but let's be real, the admin side of things can feel, well, a little taxing. Our goal here is to hand you a clear playbook so you feel totally empowered, not overwhelmed when tax season rolls around.
Okay, let's start with the absolute bedrock of a stress-free tax season, your records. And please, don't think of this as a chore. I want you to start thinking of good record keeping as your financial superpower. It is the key to unlocking some major benefits. So, why a superpower? Well, because good records literally mean you can pay less in taxes. It's that simple. You can confidently claim every single deduction you're entitled to, and you get this crystal clear picture of your business's financial health. Plus, hey, if the CRA ever has questions, you'll be organized and ready. It turns a scary audit into just a simple review. So, what exactly are we talking about keeping? Think of it like you're creating a financial paper trail. This means all your invoices, your bank statements, and every single receipt. From that new laptop to the coffee you bought for a client. Oh, and don't forget digital proof, like contracts sitting in your email. And if you use your car for work, that logbook is absolutely non-negotiable. All right, here's a number I want you to burn into your memory. 6. The Canada Revenue Agency, the CRA, requires you to keep all those records for a minimum of 6 years after the end of the tax year they're from. So for your 2024 records, yeah, you're going to need to keep those safe all the way until the end of 2030. And here's some really good news for your office space. You do not need boxes and binders overflowing with paper. The CRA is totally fine with electronic records. You can use business software or even simple apps on your phone to scan and organize your receipts as you get them. Honestly, this is a total game changer for staying organized. Okay, so you've got your records all organized. Your superpower is charged up and ready to go. Now for part 2, turning all that great information into an actual tax return. The main form you're going to get to know is the T2125. It's called the Statement of Business or Professional Activities. Now that sounds super intimidating, I know, but it's really just a summary of your income and your expenses. And the best part? If you use any standard tax software that's NetFile certified, it's going to guide you through this with simple questions and just fill out the form for you. Now, this next part is really crucial to how you report everything. There are 2 accounting methods. The vast majority of self-employed people, probably you, will use the accrual method. The cash method is really just for specific professions like farmers or fishers. The whole difference is about timing. Do you report money when you earn it or when it actually lands in your bank account? Let's make this super clear with an example of the accrual method. Imagine you send an invoice for a project on December 24th, 2025, but the client doesn't actually pay you until January 6th of 2026. With the accrual method, you have to report that income on your 2025 tax return because that's the year you earned it. The exact same logic applies to your expenses. You claim them when you get the bill, not necessarily when you pay it. All right, let's get to the part I know everyone's been waiting for, deductions. This is all about understanding the expenses you can claim to legally, and I mean legally, lower your taxable income, which of course means you pay less tax. The main rule here is actually pretty simple. A deductible business expense is any cost you had for the sole purpose of earning income for your business. That phrase right there, sole purpose, that's the key. If you spent money to help your business make money, chances are it's a valid expense. So what kind of stuff are we talking about? Well, think about the common costs, right? Advertising you did, your business insurance, professional fees, all those office supplies, and of course, travel expenses if you're meeting clients or going to a conference. If you spent it to earn income, you should be tracking it. But what about those big ticket items, like a new computer or maybe even a vehicle for your business? You can't just deduct the whole cost in one year. Instead, you use something called capital cost allowance, or CCA. Think of it like this. The CRA knows your new laptop isn't going to last forever, so they let you deduct a piece of its cost each year for a few years as it loses its value. Okay, so you know what to report and you know what you can deduct. The next piece of this puzzle is when to report it. Missing a deadline can get really expensive really fast, so let's get these dates straight. Now, this is probably the #1 thing that trips people up, so listen close.
as a self-employed person, you get an extension to file your tax return. That deadline is June 15th. However, and this is the part you cannot forget, if you owe the government money, your payment is still due by April 30th. Just remember this: pay by April, file by June.
And this is exactly why that April 30th date is so critical. If you owe money and you don't pay by that deadline, the CRA hits you with a late filing penalty, and they start charging you compound interest every single day on what you owe. It's a really easy and expensive trap to fall into, so always aim to pay on time. Finally, let's tackle two of the biggest deduction areas that can cause a lot of confusion: claiming expenses for your home office and for your vehicle. Claiming home office expenses is actually way simpler than it sounds. It's just a basic calculation. First, you measure the area of your dedicated workspace. Then, you measure the total area of your home. You just divide the workspace area by the total area, and boom, that's the percentage of your home expenses you can claim for your business. And what kind of expenses can you apply that percentage to? Well, a portion of your utilities like heat and electricity, a portion of your home insurance, your property taxes, and even the interest part of your mortgage payments. It's just the government recognizing that, hey, your home is also your place of business. Now, for your vehicle, the most important word to remember is logbook. Seriously, there is no getting around this. To deduct any vehicle expenses at all, you have to keep a detailed record of the total kilometers you drive all year, and then specifically track the kilometers you drive just for earning business income. The CRA is extremely clear about this. They say only the kilometers you traveled for work are deductible. This means personal errands, like stopping for groceries between 2 client meetings, that doesn't count. Your regular commute from home to your office doesn't count either. That logbook is your proof, and it's absolutely non-negotiable. You know, when it all comes down to it, it's about this. Good habits and the right knowledge can turn all that tax stress into real financial confidence. You now have the playbook for tracking, for reporting, and for deducting. So the only question left is, what's that first small step you're going to take today to really take control of your finances?